It's game over, Fed, as the economy is headed towards a hard landing. I'm your host, Steve Van Metre, and thanks for joining me today. And while investors are betting big on a Fed pause at the upcoming meeting, which could send stock prices higher, well, the Fed is about to do what it always does, and that's over-tighten until the economy crashes. Let's head over to Wall Street Journal, where we picked today's story up. As a headline, non-farm payroll added 528,000 jobs in July, busting and breaking a consensus of 250,000 jobs, sending the unemployment rate down. The unemployment rate fell to 3.5%, a half-century low, as just seen before the pandemic in early 2020. And the labor force participation rate, or the share of adults working or seeking a job, also ticked down to 62.1% in July from 62.2% a month earlier. Average hourly earnings, which the Fed has been concerned about that could cause a wage price spiral, grew 5.2% in July from a year earlier, although remain well behind inflation. And the job gains were widespread last month as employers in leisure and hospitality added jobs at a solid clip as restaurants and bars continued to recover. Payrolls also grew in healthcare and professional and business services, which includes many white-collar jobs. Industries vulnerable to the Federal Reserve's interest rate increases also performed well in July. Construction firms, manufacturers, finance companies all added to the payroll, and this is what the Fed, doesn't really quite want to see. They're trying to slow down the economy without crashing it. Now, what we would expect based on the unemployment data is you would expect to see these numbers come down a bit, but they went high, and that's not necessarily a bad thing. It just means the Fed is going to do what it always does. They're going to look at the data, and now we know that come September, the probabilities of a Fed rate hike are now gone right back up. Let's continue on, because companies used to reach for layoffs as a first option, and now we're seeing slower hiring as number one option, followed by targeted hiring freezes, followed by targeted layoffs, followed by broader layoffs. Federal Reserve officials are hopeful they can achieve a soft landing, which is the dream of every central banker, for the U.S. economy as they try to bring down the highest inflation in 4 decades without a major increase in unemployment. Federal Reserve Chair Jerome Powell told reporters recently that the number of job openings could fall significantly without a big rise in unemployment. And all he's trying to say here is we could see job openings going down because people are taking jobs, and that doesn't mean they're going down because employers are laying off, although we've made the case in the show here recently that that is unlikely the path that will happen. But from a central banker's perspective, if you look at today's payroll data, what do you see? Job openings come down, payrolls going up. This is exactly what they're hoping for, but they're going to end up being wrong, as they usually are. Federal Reserve Chair Jerome Powell said in a press conference, this is going back to the last meeting, that it doesn't make sense the economy would be in recession, given that monthly payroll growth has recently been averaging 450,000 jobs, and that the employers added 2 million jobs in the first half. And again, I bring this up, we go back to the previous FOMC meeting, because I want you to see how fixated they are on the non-farm payroll report, which is not only lagged, but subject to heavy revisions later on, and that those revisions often can come a year or more from now. He says, I do not think the economy is currently in a recession, and the reason is there are just too many areas of the economy that are performing too well. And he goes on to say that growth is slowing for reasons they understand. Well, not so much, but they expected growth to slow, and there's more slowing going on now, but you wouldn't know that based on the non-farm payroll report. And Treasury Secretary Janet Yellen weighed in. This is, again, going back that the U.S. economy is in a state of transition, not recession, despite 2 consecutive quarters of negative growth. Recession, Yellen insisted, is a broad-based weakening of our economy that includes substantial layoffs, business closures, strains in household finances, and a slowdown in private sector activity. She said that's not what we're seeing right now. When you look at the economy, job creation is continuing, household finances remain strong, and consumers are spending, and businesses are growing. So while we may have had a tactical recession, we're seeing, of course, the economy look pretty strong. And what will happen is investors will misinterpret this, the Fed will misinterpret this, because there's a reason why we're seeing these jobs increase. It's not unusual. In fact, I'll show you it happens during times where the consumer price index is high because wages aren't keeping up with it. And so here we have the non-farm payroll report showing the change in thousands of jobs every month, and that's in blue, and we're going to overlay the consumer price index in red on a year-over-year rate of change. And notably, where you see the red part spiking, it's not unusual to see job gains spike with it. So here we can see, of course, consumer prices rising. We're seeing a slowdown in job creation and then a little spike. Here we see a slowdown. There's some spikes in here. Slowdown and then a spike. Slowdown, spike. Slowdown, spike. Slowdown and a spike. And this happens again during periods where consumer prices are high. Now, why might that happen? Well, you probably already know the answer, because when we look at this chart here, average hourly earnings of all employees, and subtract off the consumer price index, what we know is that even though wages rose at 5.2% year over year, what's the big problem with that? Where's inflation? It's over 9. And so employees aren't keeping up with the cost of living. And what does that mean for people? It means they're likely to go get a second job. And that's what we may be seeing in this report, but more on that a little bit later. Is one thing that didn't make sense is the labor force participation is rolling over and looking like it's headed lower. Now, the labor force participation rate is a percentage of working age people that are participating in the labor market, which means they're working or they're looking for a job. And so if we see this number goes down, it means fewer people are participating. But the way we can interpret what happened this last month is that all these people that went back to work, well, they're people that were looking for a job. They weren't new people entering the participation rate, entering the labor market and saying, hey, I want to look for work. And that's something the Fed actually wants to see happen. Because what we're going to likely see now is the bond market. And this is really key. The bond market is already telling us that the Fed has overdone this, that they're tightening too much. We know the probabilities by September are still going to be there because payrolls are a lagging indicator. I'm going to show you that. But the bond market's telling the Fed, you're going too hot, you're going too fast, and you're going to crash and create a hard landing. And here's the evidence. So as we look at the yield curve, which is 10-year Treasury yields minus 2-year Treasury yields, and we're going to overlay again that non-farm payroll report in blue. And what we can see is periods during inversions where you see the red line way down here, you can get spikes in the non-farm payroll report. It's totally normal. Here you can see an inversion, and in that early stage, you see a slowdown in payrolls followed by a spike. Here you see the payroll starting to slow down a little bit, an inversion kicks in, and you get a bit of a spike, and then the recession, you see that slowdown in payrolls, the spike, the renaissance, as again, you have an inversion. And so what the Fed's going to do here is they're going to misinterpret this, much like many investors, and that's going to cause a hard landing in the economy. But there's one thing that shouldn't experience a hard landing when all this goes, and that's your portfolio. I'll put a link up here in the corner and description below, because Portfolio Shield hedges with bonds. And when the Fed screws up, which they always do, interest rates crash, bond prices go up, because I want you to see that investors are completely mispositioned for what is coming, and today's non-farm payroll report isn't going to help the case as they look to cram more money into stocks. As this, according to Bank of America, looking at their equity allocation of their private client holdings with a peak of 66, they're now back up to 63% as more money comes crowding into equities. And at a time when the yield curve is telling you either you need to have bonds or you need to have a strategy that can hedge with bonds. Well, what are investors doing? Well, their average holding is around 28.6% of their portfolio in bonds. Right now, it's down to 18%. The low, just 17. Investors not prepared at all for what's coming, and in no position as you're about to see to take advantage of anything because they're overcommitted in their positions. As you see, cash positions on average are running around 12%, with the trial here in 2008 around 11, and you can see cash positions are below average, and that will change. And it means that investors just don't have the ammunition to hedge their portfolios properly, and what will happen is they'll end up selling equities and driving their cash position higher. Now let's head over to our chief strategist, Jeff Snyder, to get a look at what he's looking at in terms of the unemployment data from yesterday, because we know he's going to have a comment about this about the establishment survey and what it means from the household survey perspective. You want to see what he has to say, my reports, Tracy's shoe charts. There's a link in the description below for Markets Insider Pro, completely free right now for a limited time. But let's look at what Jeff had to say about the unemployment claims. He said this wasn't intended to become a weekly fixture, yet constantly rising claims for unemployment insurance benefits give us real-time an unfiltered window into the status of the labor market without suffering the same statistical subjectivity contained in the establishment survey. What he's referring to is today's payroll data. Furthermore, the trend's timing and its persistence matches up with everything else of note. He says going back to mid-March, the yield curve inversion, as we've talked about, preceded by the Eurodollar curve inversion several months earlier, domestic gasoline use, and a growing consensus for at least an economic slowdown, where before had been only talk of overheating and good splurging consumers far into the future. It's not where jobless claims are now, he says. It's where they might end up, understanding that at some point, the speed at which they get there won't be continuous. What he's suggesting is there's likely to be a big increase at a time when we're still could be adding jobs to the economy, according to the headline payroll report. But why is that? Well, it looks like Zero Hedge answered the question that I kind of pointed out earlier. It's multiple job holders, and something snaps in the job market as multiple job holders hit all-time high as unexplained 1.8 million jobs gap emerges. In fact, since March, the establishment survey has shown a gain of 1.68 million jobs, while the household survey shows an employment loss of 168,000. The trend has persisted into June when, according to the Bureau of Labor Statistics, the U.S. labor force saw a 71,000 drop in full-time workers, offset by a 384,000 gain in far lower-paying part-timers. The offset, while multiple job holders, or people who have more than one job, is shown below in their chart, which we're not showing on this show. While the number of total employees per household survey has stagnated, the number of multiple job holders has been growing steadily, hitting a new post-COVID high of 7.541 million, and that starts to answer the question of what's going on here. Is households struggling with inflation? One person now holding two jobs, and as Zero Hedge finishes their story off, they say what's going on here? The simple answer is fewer people working, but more people working more than one job, a rotation which picked up in earnest sometime in March, which has only been captured by the household survey, because we didn't see that in the participation rate. We're not seeing it anywhere else, but it starts to add up. Is people can't keep up with inflation. There's people going back to work. The Fed can't see what's happening, but we're headed toward a hard landing. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.